Hello everyone, how do you do? This is Eamon Gebre from Sarwa, Head of Wealth Advisory. How is everyone doing today? I hope you had a spectacular weekend. I don't think anybody signed in as yet, so I'll maybe give it a minute or two. Hopefully individuals can start joining us. First one in is I am Farhan. Pleasure to see you again. And Abdulaziz, hello to you too. And Abdulaziz number 2, pleasure to see you as well. It is D. We've got YZ, Moses in the house, and Omar. Great to see you again. Definite pleasure. It's really nice to see the same crowd coming in over and over again. It's a great vote of confidence. I really appreciate you guys entertaining me, really, at the most part. We've got Shireen, hello, and I know who Shireen is, and I know she's in France as we speak. Parlez-vous français? Oui, oui. Je m'appelle Amen. Pleasure to see you again. And Abdulaziz, pleasure to see you as well. Lucy, thank you for joining us, as well as Sweet Angel, maybe, or for sure. Let's take the positive on that one. Julia Phillip, thank you for joining us as well as Drago Spectre. That's a pretty cool name all together. Abdul Karim, pleasure seeing you again. Thank you for joining us for another installment, guys, of Market Snack. And Dania is joining us as we speak as well. So again, my name is Eamon Gebre, Head of Wealth Advisory here at Sarwa. It's always fun. It's a pleasure to speak with you guys and to kind of keep you abreast about what's been happening in the market. I've presented some material. I've prepared some material that I want to share with you guys to keep you informed, to help you understand about what's happening in the market. Knowledge is power. It'll give you a great level of confidence to understand what's happening so that it can help you control your emotions when it comes to investing. Got a question here, but Abdulaziz says, can I intern at your firm as an analyst? You're a recent graduate. Abdulaziz, please do reach out to us. I know we don't have any postings for any internship as we speak right now, but feel free to send me your details. My email address is amin.gebre@sarwa.co. I know imminently we're not looking for any interns, but that situation can change rather quickly. Startup space is very exciting and very agile, and there may be an opportunity for you to come in and join us. We've had a number of interns over the years, probably looking to revitalize that again. Sohail, thank you for joining us, and Ahmad, and also Andre, thank you for joining us. We've got about 16 people so far. I think that's good enough for us to start. Maybe everybody give me a thumbs up or a wave for me to go ahead and start. On the thumbs up. Maybe people are looking for that thumbs up button or the wave button. And Useless Fish, always a favorite. Thank you for joining us as well. Shall we get started, folks? Yeah, the hearts say yes. Excellent. Well, let's start with right off the top, where are the markets standing as we speak today? So we are Monday, first day of the market. Looking at the S&P 500 is still in the negative territory, and I think that shouldn't be a surprise for most individuals who are on the chat with us today. So you've got negative 7.6% on the S&P 500 year to date. Dow Jones Industrial Average is also in the negative territory to the tune of 5.08%, and the NASDAQ, although it had some nice recovery last week Friday, and I don't know if anybody was watching the markets on Friday, but it was a very nice run up in the markets where we saw the NASDAQ jump by 3%, but still year to date, we're in the correction territory. We're looking at negative 13.03% year to date on the NASDAQ itself. Now, other markets around the world, I know we tend to spend a lot of time talking about the US market, and arguably because it is the biggest market in the world, so hence a lot of people tend to look that way. But let's look a little bit further east. So let's look at the Ftse, which interestingly enough this year hasn't really been impacted as much. Don't get me wrong, they haven't really grown either, because year to date they're at negative 0.29%, so really negligible at this point in time. So no growth and no reduction in values. The Nikkei unfortunately hasn't really favored as well. You're looking at negative 7.85% year to date. Hang Seng is in a positive territory, so it's nice to see some green color on those numbers. For once, it's 2.27% year to date, and the Shanghai Composite, you're looking at it being negative 7.46%. So it doesn't look exciting. It doesn't look great, to be quite honest with you. But let's talk about some news that did come out last week that I think it's worthwhile looking into, because a lot of people tend to think of doom and gloom, that there's something's wrong with the market when we're seeing all these negative returns or negative results. But really, sometimes you have to kind of ignore that noise and look at the bigger picture. Let's take, for example, Apple, right? Apple had its biggest quarter of sales ever in the 3 months leading up to Christmas. And they're just reporting it now, of course, right? Because we're in the first quarter of the following year. Despite having all the supply challenges, much like every other companies, because they do rely on quite a bit of their, on their operations overseas and shipping of the phones and whatnot. But despite all that, they actually had the biggest quarter ever in sales. Their sales last quarter jumped up 11% to an expectation beating $124 billion. Yes, with a B. $124 billion is what they generated last quarter. And their sales grew across all the product line with the exception of iPads. Maybe people are getting a little bit tired of the iPads. Maybe you want something new. Maybe Tim Cook's got something up his sleeve. Let's take a look. But interesting to see that because their shares jumped up by 5% last week, which is really kind of cool to see. McDonald's, which I don't know how many of you are still eating McDonald's. You probably have moved on to a lot more healthier items. And nothing against McDonald's. I know they've revamped their menu quite a bit to take advantage of this health drive that we're all in today. But they had a mixed bag, mixed results, interestingly enough. So their revenue reached $23 billion last year. So they're definitely still making money. People are still eating, the Big Macs and the Chicken McNuggets. And interestingly enough, that actually makes up about 60% of their global sales. That's right. The Big Mac and Chicken McNuggets are the two of the biggest menu items on the McDonald's menu that make up 60% of their revenue. What happened though, although they did really well last year, they had challenges when it comes to labor costs. And we've talked about the challenges that's happening right now is that individuals are underemployed, if that's a better description of it, where individuals are expecting a higher wage, and of course that's transferring over to the F&B industry. A lot of states and also a lot of provinces in Canada and other parts around the world have raised the minimum wages in order to try to keep up with inflation or cost of living, and that of course kind of did eat into their profits. In addition to that, also they're having supply chain issues as well, so their cost of goods is increasing. So when you're looking at, for example, patties or paper bags, for example, all those items cost them more, and the result, they actually have to pass on those expenses. They don't have to, but they do. They pass on those expenses on to consumers like you and I. So their menu prices have actually jumped up by 6%, and they're expecting it to double by the end of this year. So do expect to pay a little bit more for your Big Mac. And in case you ask for sweet and sour sauce like I do, that might cost you more than 25 fils nowadays. MasterCard has had a really decent quarter, and it's kind of reasonable to expect that because we've seen a lot more international travel over the last, especially second half of last year. As we got the Delta variant under control, people felt a little bit more comfortable. Everybody was immunized or vaccinated, sorry, not immunized. And as a result, to give people the confidence to start traveling again. And when you start traveling, what do you tend to use? Credit card. And MasterCard saw a 43% jump in profits, much of which was attributed to the foreign exchange fees on your card. It's one of those things that we talk with our clients a lot about, especially if they start talking to us about their expenses or whatnot. And I say, just keep an eye out on your foreign spend, because credit cards can sometimes charge you upwards of 5% on FX margin. So that's quite considerable. More local news here. And by the way, guys, if you have any questions, please just fire them away. I am going to be answering them shortly. In local news, I don't know if anybody saw this, it just came in a few minutes ago, but corporate tax in the UAE. Dun, dun, dun. The UAE Ministry of Finance has just announced that they're planning to introduce federal tax on corporate earnings for the first time ever in the history of the UAE, thereby just basically scrapping the levy-free regime that we've been enjoying for many years that's helped make this place a magnet for businesses all across the world. Now, of course, more details are to come. We don't know how all the intricate details is yet, but do keep an eye out. If you're a business owner, you may be, having another line item when it comes to corporate tax at this point in time. And we're not talking about just VAT. We're actually talking about corporate tax. Let's see where this goes. Now, internationally, what's been happening beyond just what's happening in the market? What's been going around? What's been the topic of conversation? Well, we know we talked about interest rates in the US a lot, in the last session and the previous session, about this doom and gloom that everybody's fearing about interest rates going up in light of inflation increasing. Well, the UK, or more specifically Bank of England, the Bank of England had already raised interest rates back in December. They actually raised it from 0.1% up to 0.25%. Well, they're expecting to increase it even more, and they're expecting to increase it by a further 0.5% by spring. And the whole idea is to try to, pacify this inflation impact that's happening also in England, and they want to basically get ahead of it. The numbers are going to start reporting in, and they are expecting to have really high numbers, and as a result, they're going to be increasing their, the cost of borrowing for individuals and institutions, and this will translate, of course, to the bank as well. Bond yield have been increasing as well to all across the globe, which has put some sensitivity on global bond portfolios. So whether you are in our portfolios where you have international bond exposure and you have U.S. bond exposure, you must have seen some valuations, or your values typically gone down at that point in time. And this is to be expected because newer bonds are being issued at a much higher yield, and as a result, investors are dumping the old bonds and purchasing new bonds, happening a lot more on a grander scale, obviously on an institutional side, because they tend to think more short term versus long term. But what you're seeing is a cycling from tech companies or growth-based companies. They're selling their positions and transferring those positions over into newer bonds that are being issued. And that's putting a lot of downwards pressure on existing bonds that are in the market. Russia-Ukraine conflict, it's not gone away. I mean, that is still a topic of conversation. And the potential invasion of Ukraine by the neighboring Russia would likely be felt across a number of markets, or maybe not. I mean, history will kind of tell us at that point in time if it has a significant impact on global markets, but that is something that investors are keeping an eye out on. Now, in light of all the news that I've shared with you, does that mean, okay, panic, exit, let me get out of my investment? Not so much, okay? Now, I can understand looking at 2022 is very different than 2021. 2021 was an amazing year, and 2020 was even better despite the market volatility that we experienced in March 2020. Unfortunately, this year, the start hasn't been the greatest, and it's been a little bit of a delayed start to the year. In fact, we've seen the high-flying tech stocks have been the most under pressure, and as I said earlier, there's been a cycling from these high-tech stocks or these growth stocks all the way into moving from selling their positions in these high-yields, high-growth stocks, and basically placing with bond yields because some institutional investors just want safety. They want something in the near term. They'd rather have a guarantee, for example, 4% versus a potential added 10 to 15%. And that's where you're seeing a little bit of cycling on there, okay? And of course, it goes without saying, we talked about this in the past, we are expecting interest rates to rise. The estimates are anywhere between 3 to 4 raises this year, and they can range anywhere between 0.25% to up to 0.5% or potentially higher. I think we're going to know as we get closer to the date, because there's an expectation by the end of March of some sort of movement in this field. But there's so many variables, right? I mean, the whole main goal of raising interest rates is try to slow down a heating economy. But there's other variables, right? I mean, who knows what can happen between now and March, right? Maybe there's, and not that I'm wishing for it, of course, right? But there could be potentially another variant that could be impacting the economic, engine of the world. And that may slow down productivity altogether. So it's not that I want that, it's just that could be a possibility. And we will know at that point in time how that materializes. Now, what that means in the meantime, though, is that if interest rates are going to go up for individuals who do have loans, credit card balances, credit card balances are typically pretty fixed in this region, which average anywhere between 30 and 36%. So it goes without saying, prioritize that if you have any balances being carried over on your credit card. But if you have a mortgage, more specifically a variable rate mortgage, it may be worthwhile having a conversation with your bank. Try to speak to them about locking in your rate. Because as interest rates rise, and they're expected to rise over the next couple of years, you may be paying a lot more than you had budgeted for, or more than you were expected. So it'd be worthwhile having that conversation, or any other variable rate loans for that matter. Try to see if there's an opportunity, whether it be with your institution or with a different one, to lock in that rate. Now, again, with the backdrop of all this volatility, I think it's important to kind of highlight there isn't any systemic problem happening in the markets. As I've highlighted, companies are still profitable. We're still traveling. COVID at this point in time seems to be under control for the most part. Don't get me wrong, not to generalize, but for the most part, we're in a better position now than where we were a year ago, right? So it's not that there's anything systemic. It's just a little bit of a cycling right now where we're seeing this transition, where we're seeing interest rates increase, and the investor sentiment has basically reduced. and most likely it will return. It's just a matter of just being patient and not being fearful and panicking, and really having more of a long-term view, because we've been here before. And if any of you have joined our webinars in the past, we always talk about the cyclical nature of markets, and that how markets generally trend upwards over the long term. So it's just a matter of just being patient. Now, as an investor, what should you be doing right now? We know that there's volatility. The chart is going up every single day. So what are your options, right? So solution or option number one, carpe diem, or seize the day. Well, let's change that a little bit. Let's call seize the opportunity. If you have been on the sidelines all this time and you're waiting for an entry point, now is the best time to jump into the market if you're considering jumping in anyways, okay? Of course, it goes without saying, we're not talking about timing the market, but if you were just on the cusp of starting to invest and you were just waiting for the ideal time for you to start based on your own personal circumstances, consider now. Prices are back to what they were towards the end of last year. So you're getting an opportunity to buy in at a price point that you missed out on earlier. And we talked about in the fact that, year to date last year, the S&P, returned a growth of 27%, or market grew by 27%. And that was a really spectacular year, and even better the year before. Well, here's an opportunity now that you've been waiting for and asking for. Well, it's there. So option number one, take advantage of it. Make sure, of course, the fundamentals of your financial picture are in place. So we're talking about making sure that your emergency reserves is set aside, and that's, in my opinion, it's not negotiable. This is something that you want to set aside in case there's any emergencies, any interruptions to your income, and you have that sitting there available at your fingertips, whether it be in your savings account or current account, whatever flexible means that you have something accessible. Make sure your debt is under control. Debt eats into your net worth. I can't tell you about how many individuals will be very good at earning the cash flow and investing, but yet they're losing it on their debt on the back end of things. So you want to make sure you prioritize that. Have a budget and plan. We believe in the 50-30-20 rule, which is as simple as just trying to limit your fixed expenses to be no greater than 50% of your gross income, your discretionary expenses to be no greater than 30% of your income, and that 20% is your sweet spot. Invest it. Put an automatic contribution into your Sarwa account or whomever you're investing with. Just prioritize yourself. Pay yourself first is what I would say. So number one, seize that opportunity. Number two, if anything else, do nothing. Sit still. Literally don't do anything, because if you make any changes to your portfolio, more specifically, if you exit from your portfolio, history has shown us time and time again, you're going to miss out on the expected growth in the portfolios. I'm going to go into a little bit more about bull markets and bear markets, and as far as how long they last, and trying to help you paint a picture. But at the very least, do nothing, because if you let your emotions dictate what your next steps are going to be, likelihood is that you're going to exit and you're going to miss your opportunity when the market goes back up. So just remain invested. You're being rewarded for staying nonetheless. You're receiving dividends, in which a lot of people tend to forget about, but you're receiving dividends, income. These companies are profitable, so they are going to be paying out their dividends. So might as well enjoy it during that period of time while you're waiting. And keep in mind, you actually don't lose unless you sell. The value may have gone down, but you actually haven't materialized any loss until you sell. So why do that to yourself? Think about your future. Think about the fact that markets do recover. Think about the fact that markets generally appreciate in value over the future or over the long term. And you want to be a part of that growth. You want to be a participant versus just an observer. And the last option that you have is that if this recent market volatility has taught you that maybe you're not ready to invest at this level of risk or this level of volatility, then maybe as a last resort, consider reviewing your risk profile. Maybe a portfolio made up of just equities may not be ideal for you. Maybe you need some safety. Maybe you need some cushion. And that's where maybe a fixed income exposure to your portfolio might help out, just to help you remain invested. To give you an example, if I had, an individual who decided to go into the most, riskiest portfolio, but really is not personally comfortable with that portfolio and that level of volatility, versus another individual who maybe took a more conservative approach. Maybe let's just say they took balanced, or maybe, conservative, let's just say as an extreme example. I would much rather have that individual remain invested for that entire duration of their investment career under a balanced portfolio versus an individual who takes a growth portfolio and exits a year or two later. Because at the end of the day, the person who stays invested longer tends to be able to achieve their financial goals in comparison to the person who gets nervous, exits, tries to come back in, comes out again and whatnot. So it's all about time in the market and not timing in the market. So that was what I would say are three key things. And just to kind of leave off on that note, and I'll start taking some questions right now. The average bear market. Okay, and we talked about this in the last week. It's a period of time where basically portfolios or the markets are underperforming, and you're looking at a negative 20% return, over overall markets during that period of time. So the average bear market actually lasts about 289 days. And for those who are doing the math in their head, how long that is, 289 days, I've done the math for you. You're looking at 9 years and 6 months. This is what the average bear market has been, going back so as far as we can actually go when it comes to calculating bull and bear market timelines. Well, guess what? The average bull market lasts for 991 days. That's 2.7 years. And what this goes to show you is just remaining invested, you'll have more ups than you will have downs. And it's just a matter of just sticking around to enjoy the benefits of your decision that you've made. On that note, thank you for tuning in today. I'm happy to answer any questions that you guys may have about Sarwa, anything we can help with. So I'm just going to take a look at the questions that were already posed to me in the last few minutes. So bear with me while I read them, and I'll be able to answer those questions for you. Okay, so we got that question about Abdulaziz. Yes, about the internship. So do reach out to me again, amen.ghebre@sarwa.co. The next question is Omar. He said, are you still searching for customer excellence positions, night shift? I believe so. We are. My colleague Hannah actually is the one who runs that division itself, and I know that she has been looking for some more individuals. We are growing the team. Please do apply on our website. If not, again, feel free to send me your CV over to me, and I'll be more than happy to share it with the individuals that have to take a look. Yes, but if any individuals who are on the call today are interested in joining the Sarwa family, and it really is a family here, we're more than happy to take a look at your CV and see if there's an opportunity for you to join us. Shireen asked what to do when markets are down. How does Sarwa manage market fluctuation? Okay, so I'll take it in two parts, right? So you've got what to do when markets are down. And of course, we talked about the three options, which is take advantage of it. If you have idle cash and you're planning on investing anyways, it's a great opportunity for you to come in. Secondly, basically to do nothing, just be patient. And I'll explain as to why in a second from the context of what Sarwa does. The third point would be just to maybe review or reassess your risk profile. If you're not comfortable with the risk profile that you're in, then you can always look at reducing your risk profile to help you remain invested. And when you get your confidence back up, and I find, experience being a really great teacher when it comes to markets. I've been in the industry for well over 20 years. I started quite young, and I have been through so many corrections. I've been through so many downturns. And it's come to the point, it's not that I don't care anymore, it's just a matter of that I know it's going to come back because I've been through so many of them myself. I've seen my portfolio, I've seen clients' portfolio over the years just gradually just tick upwards and then forth. The goal is just to kind of stay invested, and if you have a long-term goal, it just works really well for you. Now, what does Sarwa do here, right? I'm going to talk about specifically Sarwa Invest, okay? In Sarwa Invest, for those who are already investors of Sarwa, so what happened in that case is that we provided you with a very well diversified portfolio with negative correlation across different markets around the world. So you have your US exposure, your emerging markets exposure, you have your developed markets exposure, and depending on which portfolio you're in, whether you're in our halal portfolio, which would be in sukuks and gold, or if you're in our conventional portfolio, you'll have fixed income, of which is local, local in the US, or international exposure, and you'll have exposure to REITs. The beauty of this portfolio is that you're so diversified that you are reducing your overall risk but increasing your opportunities for an upside. So I mentioned earlier in the conversation that yes, the tech stocks are being impacted, Well, that's a great thing, relative to the portfolio, because your entire portfolio is not made up of tech. You actually have consumer staples, you have financials, you have energy. There's so many other industries that you're invested in to help you offset any losses that you have in your portfolio. Now, does this mean this is going to eliminate volatility? And this does not, and this will mean that it'll, eliminate you from any, a negative impact to your portfolio? No, absolutely not. If the market, your portfolio is a representation of the global markets itself. And we know that the global markets don't act in uniformity. One market will be up, one market will be down, but the aggregate of all those markets will yield you a positive return over the long term. So it's just a matter of just remaining invested. What we do is to make sure that you capitalize on these market movements is that we take care of the rebalancing for you. So you would have noticed that if you drill down on your Sarwa portfolios, that we've actually provided you with target allocations for each and every one of the ETFs that you have. To take a simple example, let's just say you have 5 particular markets you're invested in, and you have a 20% exposure in each and every one. We will ensure that that 20% exposure to each and every market, which is what we calculate as being the ideal target portfolio to have, is going to be maintained. So if we start seeing a variance, maybe this one is down, this one is up, this one's going sideways, whatever it might be, we will make sure we do this on an ongoing basis to rebalance. And the way we do that is that we sell securities that are above your target portfolio, capitalize on that profitability that you've made, and redistribute them over to parts of your portfolio that are underperforming. So you're always buying units at a great price relative to the opposite, which unfortunately some individuals experience when they trade themselves, which is that you're selling at a low and you're buying at a high. So that's what the whole methodology is. And of course, on top of that, we make it even better by reinvesting your dividends for you on an automatic basis. So you don't even have to have that headache. Every time your dividends come in, we let them accumulate. And once there's sufficient balance, we go ahead and reinvest them back into your portfolio. So that's what we do here at Sarwa. Now, we do this in a very cost-effective manner, which is a really key pillar about what you should be doing, because there's no sense in paying a significant premium to your fund manager or your bank or your financial advisor when they can't dictate what the market's going to do. They can't control that. What they can do is give you a globally diversified portfolio. And that's something that we provided for you, but we can give it to you at a fraction of the cost what other institutions provide it to you for. So that way you save money, which means more money is going towards your investment, which means it's a win-win. I hope I've answered that question. And of course, Sarwa Trade, for any of those who prefer to be more self-directed and buy and sell stocks, you can't beat free. You're able to buy stocks at zero commission altogether, whether it's buying or selling. What a great way to save altogether, right? So it's a great way to kind of, hone in on the cost saving aspect of things, and you can't really get better than price than free, unless you want us to pay you to trade, and that's a different conversation altogether. Let's see here. Omar asked, I have an account. Oh, Omar, you're very active today, eh? Unless there's another Omar, and I apologize if it's not you. Omar said, I have an account at Sarwa, opened a couple of months ago. I haven't invested yet. Can we schedule a meeting? Of course you can, absolutely. It's always great to have a refresher, have a conversation with myself or any one of our advisors here at Sarwa. I'll be more than happy to. Please, if not, just trying to figure out how to connect with you, but you can always go to your go to our customer support team. Sorry, that's probably the best way, the fastest way. Just message our customer support team, whether it be on WhatsApp or whether it be on chat, and just ask to have an appointment with any of the advisors, and they'll send you their calendar access, and you can book an appointment in according to your availability. There's another question here. Sulfur asked, do you think the S&P, Russell's, Dow Jones Industrial Average are in correction or bear market? We just covered this earlier, a little while ago. So currently the NASDAQ is in correction territory as we speak right now. And whereas the Dow Jones Industrial Average and the S&P 500 is not in the correction territory. S&P is close. I'm not going to lie, it's really close, but it is not. It was at the brink of it last week, but then we had a nice little bump in the activity and values had gone down towards the end of the week. So we kind of moved away from it. Just to kind of give you the numbers once again so far. You're looking at S&P 500 is negative 7.60% year to date. Dow Jones is negative 5.08, and the NASDAQ is at negative 13.03% year to date. So they are in the correction territory as we speak. Ziad asked, on the high growth portfolio, what would your suggestion be for a 25-year-old like me? Now, I kind of have to address this in a very careful way, Ziad, because you and I, we haven't had a discussion as yet as far as what your personal goals, your objectives, your current financial picture. It's a touchy area because I don't want to give you just offhand advice and tell you, yeah, that works sense, it's absolutely perfect. But what I can say is that maybe have an appointment with one of our advisors to kind of look at your account, look at the risk profile that you've chosen to see if it's suited for the goals that you have in mind. Now, what I can say, Ziad, is that over the long term, assets generally appreciate in value, right? For investors who have chosen a higher risk component, have been rewarded greater than an individual who has had a lower equity component within their portfolio. I'll repeat that again. Individuals who have taken more of an equity-based position over the long term have had greater returns in comparison to individuals who have had lower returns. There's a lot of caveats to this, of course, which is, what diversification, which investment decision have you made? There's a lot of caveats to this, so it's very difficult for me to give you a black and white answer, but at a general high level, yes, equities have, typically drive returns. They give you the best returns over the long term, although you have to have the stomach for that standard deviation that kind of, might not be for the faint of heart, right? So if you're okay with roller coasters and you're comfortable and you have a view for the long term and you have a comfort level understanding that markets generally appreciate over the long term, that might work out for you. But again, Ziad, have a call with one of our guys. I'd be more than happy to have a chat with you. Let's see if there's any more questions coming in. Ziad also said, I'm also all about maximizing my gains and I've been suggested to trade, not to put money into a portfolio. But here's the thing, to each his own, of course, it goes without saying, Ziad, right? What I will say is that trading is, if you have the inclination, capacity, and I would say curiosity to learn and ability to focus on this, you can do well, right? That's the reality, Ziad. Unfortunately, most individuals don't, especially when you have, gainful employment, you may have your own personal hobbies, you have obligations to your family. And keep in mind, while residing here in the UAE, the markets are open in the evening, right? The US markets are open in the evening, so that's 6:30 in the evening, which is like prime time for your downtime. Is this within your capacity to be able to focus on? And statistically, most individuals don't have that capacity, and as a result, at 90% of actively managed investments have typically not even met or even reached the benchmark that they're compared to. Now, when I said active investments, I'm kind of lumping trading into that as well too, because hedge funds, that's pretty much what they do, is they trade on an ongoing basis. And most hedge funds have not been able to beat, for example, the S&P 500 over the long term. There was a really great article that we released, I think it was a couple of weeks ago, by Sarwa, which basically did a comparison of the S&P 500, how it performed in 2021, and the top 39 or 38, don't quote me on that one, but it's in the article, top 38 hedge funds around the world. And believe it or not, and if you understand, hedge funds are basically institutions who have arguably, the brightest individuals, the most experienced individuals who have resources to be able to conduct research and whatnot, who really have their pulse on the market itself. Well, of those 38 or 39 hedge funds around the world, only 3 of them beat the S&P 500. You and I don't work at a hedge fund. I don't know if you do, but we've got a greater chance or greater bet just investing in a diversified portfolio of ETFs, globally diversified, and we will do better. So I think that's the best way to go. Cap Salute asked, did Sarwa change the WhatsApp number? No, we haven't. It's been the same WhatsApp number since we've existed all together. I'm wondering, Cap Salute, if maybe you had an individual's WhatsApp number. That could be maybe the culprit in this situation, because our WhatsApp number is on our website. Add us onto that. It's in our FAQs. It's on your Sarwa app itself, or if you just log into your dashboard, you can be able to message us on there. But our WhatsApp number hasn't changed at all. It's been the same. But what I suspect is that maybe you had like a previous employee's personal WhatsApp number, maybe that's the reason why it's not going through, or maybe it's you're not getting a response. That could be that. Useless Fish asked, can you share the link for that? We've got a moderator on there. How do I share that actually? Maybe what I can do is Useless Fish. Can you reach out to me or just reach out to our customer support team and then we can kind of send you the details on that one, because in order for me to do that here, I have to you're going to see my thumbs really, guys. I don't know if that's going to work out. Oh, there's a question here by I am Farhan Hussain. What happens to our investment if Sarwa plans to shut down? Well, of course, knock on wood, Farhan, I hope you're not jinxing us in this case. But even if it does, the beauty of all this is that nothing happens to your investments. The amount of guardrails that are in place at this point in time, Farhan, I can't even, I'm going to go more in a granular level here to explain. And I just realized we're over on time, so this will be the last question I'll answer, okay? So number one, Sarwa Invest. Let's talk about that. So number one, let's take it step by step. So when you fund your Sarwa Invest account, first it goes to a suspense account that we have here at our local Emirates MBD branch, and this is a governed account. So the ADGM or Abu Dhabi Global Markets basically governs this account to make sure that every deposit and every withdrawal is accounted for. I mean, it's to the level that we have to make sure that has a zero balance on a daily basis, because it's a client money account, which has governing rules in place to make sure that clients' assets are, being, managed in an effective manner. Now, once it arrives at our client money account, we send it directly over to the brokerage account. And for Sarwa Invest, we utilize Saxo Bank, right? And the beautiful thing about working with a partner like Saxo Bank is that they also have their own built-in guardrails in place. For one, all of your assets, every single share that you purchase doesn't even remain with Saxo Bank, nor does it stay with us. It actually remains with a third-party custodian, which is Citibank. So in the event that we should decide to exit from the market or shut down or whatever words we want to use in this example, or should Saxo Bank as well, your assets are safe through a third-party custodian, which is Citibank, which means that if we decide to exit from the market, which by the way, it's not an overnight process. We've got a significant deposit and large reserves with the regulators here to make sure that if we decide to exit from the market, that capital deposit is going to be utilized to basically wind down the operations. And what we would do in that case is we would reach out to you and say, hey, Farhan, we're going to be exiting from the market. What would you like to do? Do you want to just exit and take your money, or do you want us to help you, transfer your assets over to another brokerage account that you may have elsewhere? Maybe you want to decide to move it over to Interactive Brokers or any other brokerage for that matter. So in that case, that's what we do. Okay. On that note, I hope I've answered that question for you. And it's the same thing, by the way, for Sarwa Trade. This is actually basically the broker that we're partnered up with is called Alpaca, and they also have their own set of custodians as well too. Take a look at our FAQ. It's got a full rundown of the custodians and how the process and the journey and whatnot. But on that note, thank you guys for tuning in. We've got a really exciting week, by the way. We've got a deep dive into our halal portfolios happening tomorrow by our colleague, Abdul Qadir. He tried to do this last week, but there was some technical problems and Instagram wasn't really agreeing with us at that day. So that's going to be tomorrow. We also have our 4 Rules of Investing webinar with our new host or new co-host, Mr. Akshay Iyer. So do check him out. It's his debut. So please, everybody, give him a hard time. On that note, have a wonderful day and take care of yourself. Stay invested. If you need anything, don't hesitate to reach out to us. Take care of yourself.